Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Now, before I start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024 had been, I suppose still is after a fashion of sorts, is the breached and seemingly repaired dark blue September to December 2024 bear channel. It's currently 1285 to 1697, has developed into a descending expanding wedge pattern. However, since February, another pattern, the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 27 weeks ago, seemed to be a better contender in showing the bearish angle of attack. But on this one, 5 weeks ago, we saw prices push up over the bright pink upper time, currently at 1523, and maintain the move above it, despite, in real terms, falling lower. I asked this question 4 weeks ago, was this a true break upwards or just a breach higher? The reason I asked this question was because ever since then, and I say this carefully, ever since the breach higher, we have seen prices turn back lower, back down towards the breached upper time, having been capped by the overhead descending mauve medium moving average, currently at 1659, and running down along the top of the breached pink upper time. Now, there is the possibility after early last week's touch and go move higher, that we may finally be moving up and away from the pink upper time, or rather the pink upper time might be accelerating lower and then the market is able to keep up with it. But it has only been a few days and I'm not judging things on part of 1 week's actions. However, there's another large pattern complementing the previous and other bearish patterns seen here, a longer term bright red November 23 to September 24 shallower bearish shift pitchfork, which has even now, after so long, been pretty good at showing the bearish angle of attack, though over a longer time frame. On this one, we are today, as we have been for most of the last few weeks, just over the bright red middle time, currently at 1556. Plus, we are for a second week back below the green, slowly declining short medium moving average, currently 1610. Overall, I suspect something is going to give, and soon, and I'm on the watch out for what it will be. Just be aware, 2 Fridays ago saw the second lowest close we have seen since mid-April 2021, something to bear in mind. Hence, looking below the broken pink upper time, we have little, bar the late June low at 1468, until a congestion zone between 1379 to 1409, and that contains the December 2020 low at 1409, and the interesting 21st century 61.8% absolute Fibonacci line at 1382. Ice Europe white sugar in London. After all this time, there still continues to be 3 features of this market to keep bearing in mind on this daily chart. The first of the 3 patterns is the obvious and broken, then repaired, and then broken again 5 weeks ago, purple late September 24 to mid-February 25 descending expanding wedge pattern, which is currently 463.10 to way off the bottom of my daily chart. This pattern had the requisite 5+ touches necessary, made back in January this year, and has been severely tested on the top side, especially between late February to mid-April, enough that I would not necessarily classify as a descending wedge pattern after February, though I'm still keeping an eye on the extension to the upper trend line and the recent break above it, as I believe it all to be significant. Next, I also asked you 20 weeks ago, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then the market started utilizing the bright pink middle time of this bearish shift pitchfork, currently at 471.10 as an attractor, riding prices lower in a shallow glide until about 16 weeks ago, when we seemed to become caught in the well highlighted overhead congestion between 489 even to 490.10 and the bright green extension of the April to June 2021 head and shoulders neckline, currently at 493.70. We had a single attempt higher that was tapped back down 2 weeks ago, but by the gold declining long moving average, currently at 503.20, but then held up below by seeming support from the February 2020 high zone at 456.70. I asked the following question 8 weeks ago, and I quote, "What it seems to come down to is whether the market has the bullish incentive to push up over the pink middle tine, the purple upper trend line, and the bright green neckline extension right now." End of quote. 2 weeks ago we tried higher, and it had enough of a bullish incentive to do that at the start of that week, but not enough to sustain the move, only making just the one single close over all three before falling away to make that week a weekly key reversal down. However, as I also said 6 weeks ago, and I quote, "There also seems to be no immediate appetite to push too far lower right now." End of quote. Actually, I continued, and I quote again, "It all depends on what happens between where we are now and the February 2020 high of 456.60, because I imagine under that we might well see some fresh sell stop selling emerge." End of quote. Now, the reference to, and I quote, where we are now was back then to the May 2017 high at 469 even. And indeed, I would extend that, as I said 4 weeks ago, and I quote, "In that it all depends on what happens now down below the February 2020 high at 456.60 and over the green neckline extension, which is currently at 493.70, as I suspect that despite the overall bearish pressures, we may see a sideways rectangle pattern start to emerge between about the 456.60 level below and the 493 level above." End of quote. This rectangle pattern, despite the breach higher 2 weeks ago, is still, to my mind, a significant developing pattern here, but it's not having an easy time of it, as this week we have seen the market base itself on the green short medium moving average, and if not attempt a breach, then very much move up to the overhead bright green neckline extension. Now, I do note how the gold long moving average is coming in lower each day to aid in patching up any bullish breach high, but it is a shallow decline, and we might well see an attempt at a further breach high before it can come down enough to help. Watch this space. And I'd also add, as an addendum, please be aware that if you wanted to break two patterns at the same time, the closer they are together, as in the long moving average and the green line, the green neckline extension, the closer they are together, the easier it would be to punch through both, one would think. Sugar white premium spread. Things seem to be trying to resolve themselves into a pattern. We have a dark blue uptrend, currently at 118.5, that despite being breached on a number of occasions, still seems to be holding up. This now ties in with the green lower tine, currently at 117.25, of the mid-November 24 to early June 25 bullish shift pitch hook, which reinforces this pattern. However, I have a fear, and it is a real fear, that the whole February 2025 to date action may be trying to form a possible diamond pattern. And last week's weekly indecisive spinning top has not helped that, nor has this week's move lower so far. This would be a large pattern in both time, probably from February to November this year, and also in height, roughly between just under 100 up to 150. It's too early to say if this is happening, but I would urge you to keep an eye on such a possibility. So, what have we in the way of supports and resistances that may influence the market? Well, apart from the already mentioned supports below, we should very much look at the long moving average below, currently at 102.5, as this interfered and in its own way held up prices earlier this year. Below these, well, we don't have that much support until the congestion starting at 85 even and stretching down to 70 even. Now, looking topside, we 2 weeks ago passed up through and possibly started to stabilize. We look like we're not doing it now, but we look like we were trying to stabilize over the twin pair of 50% Fibonacci lines at 128 3/4 and 131 1/4, and that's for the July 19 to September 22 move and the August 21 to September 22 move respectively, plus the congestion at 134 1/4. However, as I said 3 weeks ago, and I quote, I am not inclined right now to view these in a favourable light, as they have been breached before quite sharply, despite only once having a weekly close anywhere within them. End of quote. Nevertheless, they have now become, well, they were supports, they're still sort of supports of a sort, though as you can see today, they are being tested on the downside this week. Above these, well, it was, as I said 6 weeks ago, when I looked at the top side, seeing, and I quote, a fairly free area overhead, but it ran into the significant 2013 high at 152 3/4 and swiftly turned back down, just as it did back in mid-April. End of quote. That area overhead at 152 3/4 seems to be the better resistance right now. As for the others, well, they all seem to just abrade and whittle away the bullish incentive, but on their own, not stop it. 2 weeks ago, we came up against one of these abrasives, and that's the bright green middle time, currently at 143 even, that capped the rise but did not stop the market from trying higher last week or this week, or seemingly any future week in the foreseeable future, unless we develop that pattern I mentioned right at the start of this commentary. We begin forming the large possible diamond pattern.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.